Good morning, everybody. It is June 1st, 2024. 13 days to my World Series of Poker revisit. I've been there a number of times. This is one of the shirts I'll be wearing because it gives people the creeps. All right, let's talk about how the United States is going to handle the coming baby boomer retirement crisis. Because we know that about 80% of baby boomers really don't have enough money to stay retired on. They can get to retirement, and then within a few years, they're usually at the point where they better work part-time or they just live on a very, very tight budget. And we are seeing that play out already. What's going to save some of them are pensions, but the costs for healthcare and other related services that we're going to have to provide for the baby boomer generation are going to drive deficits that drive the debt well into the 2030s. And what we have to do is figure out a way to finance that. Now, there's a phrase out there called fiscal dominance, and this is when the monetary policy loses its impact because the debts and the deficits are just driving everything. And one of the things that we talked about in the last week or two was, and really I've brought it up before, I have said that I don't believe that lowering interest rates a little bit would really stimulate inflation. I think the idea that inflation has come primarily from a printing of money or quantitative easing along with low interest rates has been wrong. I think that it's been wrong from day one. That is an Austrian economist, Milton Friedman blend of ideas that just is really proven to be wrong over and over again. While we see debasing currency as important in much of the world, the United States has stood out in a way that really just requires that people understand it and accept it. It's that our economy is so strong and our position in the world is so strong that the dollar relative to other currencies is going to remain strong. Back in 2012, when everybody was talking about how the dollar was going to fall off a cliff, I said, no, it's going to go on a long-term bull market and then stay strong. I got laughed at, I got ridiculed, I got trolled, but I was right. Here we are 12 years later, and I've shown the chart over and over again. I'm not going to bother with it today, but the dollar relative to other currencies, in an environment where all currencies have been debased by money printing, but relative to the other currencies, which is what matters, right? Everything is relative. Relative to other currencies, the dollar has gotten stronger. Basket of other developed markets currencies, we've gotten stronger. The emerging markets haven't caught up yet, even the strong ones, although they have relatively done better than, say, the euro, which I predicted a decade ago was going to get to parity with the dollar. I got laughed at for that one, and it's happened. So you have to really wrap your head around how strong the United States really is, what our flexibility really is, and what our ability to generate growth and income and just continued improving standards of living is. That's why people want to come here, and it's why the dollar keeps getting stronger, and it's why no matter what we do to offset the demographic challenges, it's probably all going to be okay. Now, that doesn't mean there won't be speed bumps. There's going to be. We are in a spot where we have to manage smartly. We can't give a whole bunch of tax cuts that aren't going to pay for themselves. And the last two major tax cuts, George W. Bush and Donald Trump, did not pay for themselves even a little bit and went mostly to the richest couple of percent of people. And I'll show that chart here in a minute. So the implication of something that Janet Yellen said this week is important because it's exactly what I've been saying. I've been saying for a long time that the United States was just going to go into a massive wave of quantitative easing at some point later this decade, and that interest rates would come down, probably not to near zero again, but to a point where the interest payments were more rationalized and provided and the interest rates would provide a flatter yield curve for the banks, so the banks could finance a number of things, in particular, housing development. The one thing that's really driving inflation in America isn't that we had quantitative easing or that we ran stimulus programs out of COVID that were far and above what COVID required. It's that we have a shortage of housing. If we can build out the housing, then we will probably see inflation be flat for a long time. And then we will eventually get to a deflationary period as the boomers start to die. And this is a long wave thing. It's going to take decades. We'll have whiffs of deflation between now and then we'll just print our way out of it, which is okay. People want to say, well, that's bad, but if it's less bad for us relative to most of the rest of the world, that means that we are exporting inflation, not importing inflation. And in the past, we have imported some inflation mainly because of China over the last few decades. But inflation really hasn't been a problem here because, again, we can allow our currency to get stronger pretty much anytime we want to. And since Barack Obama, we've allowed that to happen. Donald Trump tried to push the dollar down, and it really was just too strong for him, no matter what he did, even with the really stupid tax cuts that he did. And I say that as a major beneficiary, right? If you're in the top 5% of the population, you really, really got a lot of money from the tax cuts. Everybody else got schnibbles. Now, $1,000 schnibble for a family making 50 grand is a big deal. My schnibbles were in the 20s something per year, $20,000 to $30,000 a year I've been getting since 2018. Thank you. I don't know that it made a lot of sense for the economy that it was directed at me, but I've been able to gamble more and travel more, which I guess kind of helps the economy, but I didn't have enough to invest. And the problem that we've seen is that a lot of the money that was not taxed did not get reinvested into America. It just sits on these piles of Wall Street accounts. Joe Rich Guy has a bunch of money. He lays on top of it like the dragon smog, and it doesn't get into the economy. It doesn't become productive. It's like gold. It really is. Gold doesn't do hardly anything productive, and yet people somehow value it. So having the bigger pile, maybe it's for scoring or ego or whatever it is, but we really have trillions of dollars that need to be stimulated back in the economy, and the threat of taxation is a great way to do it. If you say, hey, either invest this money in a way that's productive or we're going to tax the hell out of it, it's a great incentive to do something productive with the money rather than just trying to skim the markets. What this chart says here is that Janet Yellen believes that we can keep the real interest as a percentage of GDP on the debt at about 1.3% per year. And that's a fantasy if interest rates don't come down. So if the inflation rate is hypothetically going to be 2%, that means that interest rates have to come down to about 3.3 for this to work. I would argue that that is the right thing to do, is to bring the short-term interest rates down to around 3%, because that would stimulate a lot of money to get involved that's sitting on the sidelines right now in building housing in particular. And if Congress can do something smart and incentivize building residential properties, I don't know what that would be, a builder's credit of some sort. There are different mechanical ways of doing this. And once we get rid of housing inflation, there really isn't a lot of inflationary things left, except something that I'll talk about at the end, which is actually a big deal, and we talked about it in recent weeks. So what Janet Yellen is saying here is that she expects interest rates to be a little higher during the next cycle than the last cycle, but the last cycle they were almost zero, so that makes sense. And to reduce the interest on the debt, we necessarily have to lower the interest rates. Grumman talks about this. Right? He points out that Yellen said, hey, we're going to have to probably have a higher interest rate than we thought. And this has to do with keeping the dollar strong. But she pointed out that her favorite metric, and the one that the Treasury's been using for a long time, is what is the inflation-adjusted interest payments as a percentage of GDP? Can we handle it? And I think this is interesting to read right here. Inflation-adjusted interest payments, U.S. interest payments, which are based on U.S. dollar outflows, reduced by whatever the government says inflation is, so they can fudge the numbers. Now, I've shown you some spikes in charts, and then some drawdowns, some spikes up and then a come down in energy, in oil production, in interest payments. And a lot of times those spikes are just adjustments in the data that were sudden. They probably should have been made over time, and the line should probably look smoother. You should expect major adjustments in the future to what the government says inflation is. Now, that doesn't mean they're lying. It means they're manipulating the data to what they want the narrative to be at a given time. In the long run, it all evens out, but they're able to push the narratives around to manipulate the public in particular and Wall Street as well. So here's where Grumman had a hard time. He said if interest payments are a function of interest rates, makes sense, right? Your payments on your debt go up when interest rates go up, go down when interest rates go down. And interest rates in the United States are almost entirely a function of inflation. You should know by now this is something that I disagree on. I'm not saying that it's not happening, but I'm saying that it shouldn't happen. As the U.S. government is nominally risk-free, right? That's what the U.S. Treasury is supposed to be, a risk-free asset. Then Yellen is deducting inflation from her model. This is hard to explain because it's circular, and he's having a harder time than me, because there are wrong assumptions from that Austrian economist mindset that inflation is everywhere and always a function of the monetary system. The reality is that inflation is a mixed bag, and demographics are the number one driver of inflation and deflation, have always been. But because the study of demographics is newer in the last 100 years and really hasn't become super important until about the 1980s and 90s, and because it's so slow moving, people ignore it, overlook it. It exists around you, but you can't see the motion and how the demographics play out. The United States is getting older. What nation do we know has gone old and suffered through 30 years of really weird monetary and fiscal policy, but yet their standard of living did not decline? Japan. Japan's the oldest country on the planet, and they've done a number of things that suddenly in the last couple of months, last couple of quarters, they're going from a negative interest rate or zero interest rate policy to actually raising their interest rates potentially to 1%. And that's a big deal because it affects where the Japanese put their money. We'll get to that in a minute. So back to the chart. With U.S. debt at 121% of GDP, which is approaching World War II levels, the average U.S. interest rates still repricing higher. The only way this chart should be flat in the next decade is, and what have I said? He gets there. He's a couple years behind me, but he gets there. Nominal GDP growth is consistently higher than interest rates. Well, we know that GDP growth will only be 2 to 3%. Every now and then we might spike a little higher. During recessions, we'll be lower. So if the average GDP growth is 3%, interest rates could be 4.3 to get here. I may have said it backwards earlier. But what if GDP growth is only 2%, which is probably closer to the truth? I think we can get to 3. We have to do some right things. We'd really have to support housing and small business, but we hate doing that because we'd really rather all invest in Microsoft, so we give them all the breaks. I believe we can actually, this is where I think Yellen is not telling everything. I think we can approach 3% of GDP growth consistently if we incentivize certain behaviors. Not just give tax breaks to the wealthy and hope they're going to do something good with it, but say, we'll give you a tax break if you do this, if you build houses, if you invest in America, in which case interest rates can go much lower. And I anticipate that interest rates are going to get down to that 2 to 3% range where GDP is, because I don't think it'll stimulate inflation. In fact, if we build houses, I think it brings inflation down dramatically. We know that housing is about half right now, historically not half, but right now it's about half of inflation. Energy has traditionally been about half of inflation, and it's not right now. It's way lower because inflation in energy has been sideways. I think that's about to change, at least for a while, until the build out of all the above is finished with solar and clean energy and batteries, but that's going to take a generation. And then the big one. What is the short 2-letter word for what I just highlighted? The Fed begins cutting rates or begins regrowing their balance sheet in coming years. What is that? QE. Exactly. So what we have coming is expansive quantitative easing, a la Japan. That's what Japan did for 30 years. 30 years. And Japan mainly borrowed from themselves. They just borrowed from the future of the country to get through a demographic decline, which demographics by generation take what? About a generation or two to get through. The United States is entering a period where we're going to have two waves that are deflationary in the next 40 years. The first one is this baby boomer wave that we're getting. And the second one is going to be the millennials because there's as many of them as the boomers. In between, we've got a 15-year period, give or take, where my generation, the Xers, will be retiring, but we're not a giant generation. We're fairly well off, but we're not a giant generation. So paying for my retirement is going to be kind of cheap on the country. But then when it's time to pay for the millennials, we better have let in that 30 to 50 million people that I've talked about. Population of the United States needs to be somewhere in the range of 380 million to 400 million in 20 to 30 years. If it's not, I don't know what happens to the millennial retirement. And millennials should be thinking about this, because if they're not, then they might as well just kiss Social Security and Medicare goodbye. And what do we know about Social Security and Medicare? Who do we know that's been trying to cut it? If you vote for that party, if you vote for the Republicans, you are voting for Social Security and Medicare to get cut because that is their proposal over and over and over again. They say it out loud. They put it in bills. The idea that it's not going to happen, like Roe versus Wade would never get overturned, is naive. You notice a change in my language. I would have said something a little harsher than naive in the past, but I'm trying to be a kinder, gentler, I was going to say green pickle, because that has been one of my new online names, but I'm trying to be a kinder, gentler joker. And I think it's very important for people to understand that I'm just looking at this economically, because ideologically, I'm pretty centrist. But from an economic standpoint, I'm looking at the reality of the United States, which is we're exceptional. American exceptionalism is real. It has to do with our geography. It has to do with just how fast the economy's grown since World War II. It has to do with not getting blown up during World War II. It has to do with a fairly educated workforce, although we're not as smart as we think. And it has a little bit to do with, can we get over being fat, dumb, and happy? Which is a story that I've told before. I'll tell it again right now. Went fishing in the early 1990s with my friend's grandfather and his friend over on the Little Muskegon River in Grand Rapids. I believe that's where we were, Michigan. And these guys were World War II veterans. One was a Royal Air Force colonel, and my friend's grandfather was in intelligence for the Army. And took fishing. They went and got us some fresh porterhouses that had been like slaughtered and aged within that week. Best porterhouses I've ever had to this day. And they said, guys, and we went through a bunch of things. You know, we were all college students. Something you're going to see in your lifetime, and we don't know when it's going to happen, but I think the seeds are here. It was the early 90s, post-Ronald Reagan. America is going to get so fat, dumb, and happy that they could do really bad things. And that has been in my head since 1992, I think it was, 1991. When are we going to get so fat, dumb, and happy and full of ourselves and confused that we do some really dumb things? Well, I would argue that we've done one really dumb thing already in the middle of a bunch of questionable things, right? Because neither side is particularly innocent. And I will just tell you right now that as we finish this presentation on what it looks like in this country fiscally and monetarily, if we screw up again, we are going to see the mother of all crashes. And we'll all get rich because I'm going to make a lot of money. If we get a financial crisis that is predictable, right? Sometimes financial crisis is not predictable. I was able to predict the last financial crisis. I was able to tell you to sell almost everything before COVID. And while I didn't think the rebound after COVID would be quite as quick as it was, I've been able to wrap my mind around what's going on and actually do pretty well despite accumulating small caps for the last year and a half, 2 years. Someday those go up, and they go up a lot. And this is going to be part of it. The quantitative easing that we saw during COVID and slightly after COVID, and now the quantitative tightening, these are just two different measures of it, has kept the dollar strong, and it has tightened financial conditions, but not to the point that people really believed. Why aren't financial conditions as tight because of the monetary tightening as people would have thought? Well, but I would argue that there's just so much money out there now, and I've shown those charts before, it's just taking longer for the economy to tighten up. And because this is a stretched out period where we don't suddenly throw ourselves into a recession after 6 months like monetary policy has done in the past. It's not as much fiscal dominance as guys like Grumman and Van Eck are talking about, although Van Eck up here talks about how you have to measure it. It's not an automatic. I would argue there's so much money out there that we are seeing the soft landing and the smoothing of a process that normally would have thrown us into a recession. The Fed can still make a mistake. And the mistake, in my opinion, would be keeping interest rates too high for too long. I understand they're trying to finesse an election. I get that. They're looking for Goldilocks. I think it's here. I don't think if they can cut a deal with Saudi Arabia on energy for a few months, and all they really have to do is cut a deal to refill the Strategic Petroleum Reserve and make sure that the Saudi refinery in the United States, which is the biggest one in the country, is running at full speed. That's all they have to do. Is cut a deal with Saudi Arabia, say, look, we'll protect you from Iran. We were going to do that anyway. And let's work on an investment deal in each other. Saudi Arabia wants that because they don't trust the Chinese or the Russians any more than anybody else does. They want to be on our side. Do they have a ruling family that is not the most savory? Sure. But look at our politicians. So if we cut the deal with Saudi Arabia, which I'm an advocate of, right? I mean, not that I want to stay on oil, but I think it would increase the odds for peace in that region, or at least no major wars. Or if there is a major war, it'd be one of those things where, you just destroy Iran's army and leadership and you let them have a democracy, which is what they're aching to have, because the Iranian people are pretty educated, pretty smart, and pretty pro-democracy. You could see a lot of good things happen. And it's going to come down to whether or not the politicians do the smart, peaceful, prosperous things. I think Joe Biden, Gavin Newsom are more likely to see those things happen, see those things through than Trump is. Trump says he's not in favor of that stuff, just wants tax cuts for the billionaires. So while I have nothing against the billionaires, I don't think it makes sense to give them tax breaks without strings attached. I'm okay with tax breaks, but there's got to be strings attached. We need this, this, and this if you're going to get a tax break to do it. Not just going to give you a tax break and hope, right? Trust but verify, baby. You're a Reagan Republican, right? Oh, no. Oh. So what does the U.S. debt look like? This is important. Foreigners only hold about a third of U.S. debt now. This is from U.S. Bank. I'll link this in weekend reading or something soon. I should have put it in this weekend's weekend reading. Public, individuals plus mutual funds are up to 27%. That's good. That's good. It's good that it's held here versus there, right? People argue, oh, look, foreign investments coming down, but American investments going up. Now, this sucks a little bit of money out of the stock market. But I just had a conversation. I just had dinner with somebody in Fort Worth where we talked about buying 2 and 5 year treasuries. Why? Why would you buy 2 and 5 year treasuries if you're sitting on a pile of cash? Why would you do that? Well, if you're a risk averse investor and you don't want to be 80 to 100% equities, 2 to 5 year US treasuries, that's the side of the yield curve where rates are going to come down. So not only can you collect that 5% interest payment, but you'll get a small capital gain. And you'll have cash recycling potentially into a stock market correction or a real estate correction that you can buy into. It's all a part of recycling your money. It's why we sell so many cash secured puts and covered calls. Just always have money coming in somehow. And people want to say, well, that's why I invest in dividend stocks, but the high dividend stocks are generally shit. But I get 10%. Yeah, but if you lose half of your principal in the next 10 years, right, it doesn't make sense. You create cash flow. This is what Buffett has taught us. Did you know that Warren Buffett, and I think a lot of you know this, Warren Buffett sells cash secured puts all the time. He's famous for it. Generate income for doing nothing. And if you buy something because prices came down, hey, I bought cheap. That's why you all need to learn how to sell cash secured puts. It is the number one financial tool out there. I will put that up against anything. Selling cash secured puts is the absolute best financial tool out there. Generate income, buy cheap. What on earth is better than that? But I can buy Altria, which has come down over the last 7 years. But I got income out of it. Yes, but at some point, your principal is smaller. How do you reinvest it? What if Altria cuts their dividend, right? It's just this yield chaser mentality, this lazy approach to investing that a lot of people have. It's going to kill them at some point because eventually we will get a recession. We'll get a wave of dividend cuts. Stock prices that come down 30, 50, 70, 90% will go to zero. And then they are zucked. And this all plays into how we're going to have to deal with the deficit and the debt as the boomers retire. And we go through this giant demographic shift that plays into how we deal with debt. And there are different paths to how we deal with this. One is somebody tells us, I'm going to give you tax breaks, mainly to the rich guys, not you. And we're going to grow our way out of it. Even though the last 3 times that we've done this, we didn't. Tax breaks didn't help. Just help people build their pile of gold. And you got a bunch of billionaire dragons laying on their piles of gold. The other major holder of U.S. debt is the Federal Reserve. I just showed you that that's been coming down lately, but will it in the future? And this is actually U.S. Government agencies and states and local governments that buy U.S. treasuries. If you don't visit the Apollo website, Apollo Academy, put this on your short list of places to go pretty much every week. Torsten Slok, I don't agree with all of his opinions because I do think that he takes kind of that bond vigilante, slightly Austrian approach that has proven to not be just right. But the educational value here is a big deal. This is the trend in decline of foreign ownership of U.S. government bonds. But take a look at where we were for a very long time. Jumped up under George W. Bush, came down a little bit under Clinton because he was the one guy that started to balance the budget. And then ever since it went up. But lately, and this has to do with China for the most part, foreign investment has come down. This is the Xi regime, which is why I don't think Xi will be, he's not going to get to be lifetime premier. This is it. This is his last run. Unless he cuts a deal with us. If Xi takes a step back from his whole, I'm going to rule the world and fuck you all approach, if he's as pragmatic as I think he could be, he's going to have to overcome hardliners that he put in place. So it's delicate. But there is a possibility this stables and even drifts up. We'll see. Nearly half of all of that debt in foreign hands is these 5 countries. And there's a weird thing here. So Japan makes sense, security partner, helped rebuild them after we blew them up. China, starting with Nixon, we helped them grow their economy. They recycled, we bought from them, and then they recycled the money back into us. So while we bought things from China cheap, they would take that money and then buy U.S. treasuries. Kind of like the Saudi deal from the 70s with Kissinger with the petrodollar. Well, we'll buy your stuff if you price it in dollars, and then you buy U.S. treasuries with the dollars that you get, right? Circular. UK, that makes sense. Luxembourg. Where the hell does Luxembourg get all this money? Anybody know the answer? Give you a fortune cookie if you know the answer. Come on, somebody say it. Where does Luxembourg's money come from? It's a banking center. It's mainly Chinese money. So a Chinese conduit into American investments has actually been through Luxembourg. And then Canada, because they're our biggest trade partner. That makes sense, right? So the amount of debt that they own has come down in China and Japan. Luxembourg's jumped up, so some of this would really be over here. So Chinese holding of U.S. debt hasn't come down as much. But this is much more in public markets, so they can trade it. So they have a lot of money that they can trade. Oh, remember I mentioned Japanese bonds getting up to 1%? Remember, they don't have inflation. So 1% is a real return for them. So this is why Japanese ownership of U.S. debt has come down. It's part of their demographic cycle that they're at the end of. So the deflationary demographics of their population they were coming down drastically for a long time, and they've leveled out. I mean, they're not improving very much, if at all, but they're not getting worse like they were. Their population's gotten about as old as it can get. Now, as people drop off, they replace them with a baby, so it evens out. This is who owns U.S. debt as a percentage of GDP, so it's going to be over 100. Bottom line is the Federal Reserve. Purple line are other U.S. agencies and states and localities. The green line is foreign debt. And then the red line is what the public owns, and this includes mutual funds and banks and things like that. Let's suppose that as interest rates come down and quantitative easing occurs, what are the 2 logical outcomes there? Which line goes up and which line goes down? Does the red line go up or down with quantitative easing and interest rates falling? Does the public invest more in U.S. public debt as interest rates come down, or do they invest less? Somebody says the red goes down and the purple goes up. Not the purple, but the blue. The blue is the Federal Reserve. So what we're going to see in the future is this line. Let's get rid of the red line. Let's make things easy. Let's see. Do I get rid of the red line? Let's try to get rid of the red line. Yeah. All right. So the blue line here, and the blue line here are the same. So this is going to go back up to the tune of potentially 20 to 30 trillion dollars over the next 15, 20 years. $1 trillion a year, maybe 2 trillion a year. Could be $50 trillion. The shortage of what's supposedly in the non-existent Social Security Trust Fund, 20, 30 trillion dollars. And then whatever we fall behind on Medicare because we're too dumb to charge corporations a tax rate that would pay for healthcare. So 20 to 30 trillion dollars, or your Social Security gets cut. So do you want to borrow it so that everybody gets their payment? Or do you just say, we'll eat cat food? Remember, 80% of the population has that decision to make. But remember, this little country, Japan, they did quantitative easing for a whole generation longer. And it worked out. So as interest rates come down in the next 5 years or sooner, and I think it should start this year, but maybe not till next year. I think this year. I still say July. But remember, I also said March. So what they should do and what they are doing are different. They don't call me yet. One of these days, they're going to call me and say, Kurt, you keep getting these things right. Maybe we should ask you. But there's politics, and I don't like any of them. So this will drift back down, probably to these levels, as the boomers die and as interest rates come down. And that money will find its way where? Well, everybody's going to buy Bitcoin, of course, because the dollar is going to collapse. Oh, wait, the dollar doesn't collapse because we're stronger than every other economy in the world and their currencies suck more than ours does, right? You can call it the cleanest dirty shirt. You can say ours sucks less than yours sucks, or you can just realize that the dollar has a better outlook than any other currency, except maybe Bitcoin. We are getting the Bitcoinization and dollarization of the world in a world that already was dollarized. And what's going to happen, and this is important, I keep coming back to it. Bitcoin is going to replace a lot of little currencies. The emerging markets, Latin America in particular, and we'll get to that in a second, is adopting it. Dollars and Bitcoin in Latin America. So this is interest payments as a percentage of gross domestic product. Got in the news this year because it jumped up. It didn't jump up for any other reason other than interest rates are higher. Interest rates go down, this falls back down to a level that we ignore again. That's why interest rates are going to come down. So let's talk about how we're going to finance all this stuff. These are the Trump tax cuts that expire at the end of 2025. I'm one of these guys, right? And I got closer to 20 grand. I'm right around 20 grand a year because of the LLCs I own. I own multiple LLCs, so I got more. Didn't make any sense. They're all kind of the same business. I just put different labels on different parts. And that's for liability reasons years ago, but they gave me a tax break for it. This is who got the tax breaks. Doom, doom. This has to go away. If it doesn't go away, the numbers on the deficit and the debt scream. If we continue this policy, if the Republicans somehow win everything and they keep this, anybody who's ever complained about the debt and the deficit and voted Republican can never, ever, they will, but they shouldn't, ever complain about the debt and the deficit again. We have fixable problems. We're going to choose whether or not to fix them. Because the path that we're on now is all right. It's not great, but it's pretty good. Because all we have to do is lower interest rates at this point, which will stimulate housing, which will bring inflation down. But lower, and I know there's a lot of heads that are still clicking, but lower interest rates means higher inflation. No, Zucking doesn't have to. It doesn't have to. It's the housing, right? The rent is too damn high that is causing inflation. We need to incentivize home ownership again. That's where the tax break should go. And it should only go to maybe your first 2 houses. You shouldn't be able to take a tax break on 500 houses because they're all in different LLCs, Trump properties, whatever. All right. I talked about this last week. Made it very clear I like Bitcoin so far on this call. What else do I like? The advent of AI, once it's built out, right? So while AI is being built out, it is inflationary, right? Because all the resources, all the labor going into it. But once it's mainly built out, what happens at a company level, at an industry level, once something is built and the capex is happening and you're spending money, that's inflationary. What happens once the capex stops and the revenues start coming in? This is going to add about 5% more energy demand all by itself in the United States. And why only 5%? Well, because right now data centers only take 3% of the energy. And that's going to jump to about 8%, depending on who you believe. EI, this is global, so it's not just a US thing, it's global. Goldman Sachs, has a good chart. There you go. Data center power demand. Now remember, this is only fraction of power demand. Let me search for the number 8. There we go. So data centers use about 3% of energy right now. It's going to jump to 8% by 2030. And then it'll be a double-digit number sometime, by 2040. So maybe it triples or quadruples over the next 15 years. It's a lot of energy that we're going to need. Not only that, but eventually EVs get here. We're not going to be able to have 80% of new car sales be EVs by 2030. It'll be more like 50%. EV sales are already double-digit percentage of new car sales globally. A little lower in the United States because freedom, America. But that's going to change because as I reported back to you after the oil conference, U.S. oil supply is going to stop growing by the end of the decade, or right around the end of the decade. The only way for U.S. oil supply to continue to grow into the 2030s, and probably it wouldn't even cause it to grow, it just stretch out the plateau, is if we drilled a lot in the Gulf of Mexico and we went really deep and did riskier drilling. Well, we're already short on fish and shrimp, those delicious crustaceans, and those really smart octopus are getting pissed off. Anybody watches Resident Alien? I strongly recommend it. They have a really smart octopus. Are we going to truly risk destroying the life in the Gulf of Mexico by drilling more oil? Did you know that most fish and shrimp in the Gulf of Mexico have traces of oil in them now because of the spills that we've had? It's true. It takes years and years for that to go away. And we're at a low point right now. It's come down. But if we drill more, it's going to go back up. So smart energy policy is the all the above. It's everything. And eventually, solar, maybe we figure out something with nuclear, but solar is growing so fast. That's one of the reasons why nuclear is not going to take off, I don't think, because solar is growing that fast and the breakthroughs are mind-boggling. They just had in the lab 45% efficiency of new solar cells. Not only the chemistry, but how they build it. The Enovix battery, it's not a chemical thing that they did. They came up with a structural thing to make it super more efficient. They're going to start what Enovix did at the battery level. Some smart scientists in some university somewhere, or some R&D department is going to go, why can't we do this at the molecular level? Why can't we figure out a way to control the energy at the molecular level so it never catches on fire? They're working on it. They're going to figure it out. So solar is going to get so efficient by the end of the decade, really, probably, that suddenly in the 2030s, this is what's going to happen, right? I'm telling you the future. You don't have to believe it now. Be very Saturday Night Live, hear me now, believe me later. By the 2030s, solar is going to be so good and the batteries are going to be so good and cheap that all we got to do is aim them at that giant fusion reactor in the sky. And so long as that's here, we'll be here. And we're going to have super cheap energy at some point. But between now and then, right, during the build-out period, during the period where oil and gas supply is flattening out, but demand is still drifting up, energy runs the risk of getting expensive. We got to work really hard with alternative energy, because if we shit on alternative energy, then you better be very, very happy with your gasoline car and your natural gas heat and air conditioning, because it's going to get really expensive. So expensive that you've seen me pivot on oil and gas in the last few years. I really thought we were going to just smoke it. I thought alternative energy was just going to take off during this decade. And it turns out it's not going to be till next decade, because Exxon is suing climate activists and environmentalists. You shouldn't be so hard on us. We're Exxon. Keep bending over, please. So I'm actually writing 2 articles, one of them for Permian Basin Magazine, about the 5 oil and gas companies, so really the 5 oil companies, to keep us free from OPEC. The thing is they don't have enough inventory to do it much longer, unless all this increase in power demand comes mainly from solar. Right now it is. Right now solar is keeping up, and wind, but mainly solar. If we kill solar again, enjoy your energy inflation. So we have choices, and we have to keep an eye on it as an investor, because if we choose to not go full force in alternative energy, it doesn't mean oil and gas disappear. It just means that oil and gas are on this level, and we got to have the other things go up to keep up with the demand increases, to save the climate, to have energy security, and fight inflation. I'm just telling you, and this is for you, not for me. And this is for your kids, and this is for your friends. If Trump wins, we're going to spike in a crash that's so spectacular, I'm going to maybe get the one of the Brewers. I might make that much money because the crash will be very similar to the financial crisis. And if it comes during a period where Congress can't work together, and the central and the Federal Reserve chairman, whoever Trump would appoint, doesn't have it figured out, it could be worse than the financial crisis. It doesn't have to be. We just have to make a series of stupid decisions with regard to energy and debt policy and tax policy. Right now, Trump is running on stupid decisions that he would make, and half the people like it. So this is my public warning. If you vote Trump in, and I'm not arguing any other stuff, Republican, Democrat, liberal, conservative. You believe what you want to believe, but maybe you impact certain things at a more local level in the short run. Because if Trump wins, he might crash things so hard that all the negative things that you hear about debt would come true. All the negative things you hear about energy and inflation would come true. And there's a way for us to get rich if all that happens. There's a way for us to get rich if it doesn't. I mean, the way things are going, we're going to get that small cap clean energy rally and we're going to make a ton of money. But there's an alternative. There's a flip side. And the flip side is, let's keep doing this. Let's get rid of alternative energy development. Let's set it back 5 or 10 years. So there you go. This is what we have to figure out that we're dealing with between now and November. I think the market's going to chop along and inch its way higher, especially if they cut interest rates and they describe it the way that I've said they should describe it, which is, hey, we're just going to flatten out the yield curve so the banks can build more housing or finance the building of more housing. If they describe it the way I said they should describe it, I'm going to write an article about it and hopefully they read it, because this is what all the private equity guys are saying. This is what all the developers are saying. Hey, that subdivision I want to build in, they can't build it because they can't put in the roads, because they can't get the loan because the internal rate of return isn't high enough, so they wait. Now, I would argue that the waiting is an opportunity cost that they ought to just have worked their way through, but nobody looks out 2 or 3 or 4 or 5 years anymore. Everybody's like, what's going to happen this year? That's why so many people can't beat the stock market. So there you go. We are going to get, at some point, a lot more quantitative easing. This blue line is going to go up, and it's going to last for a very long time. It'll go up in steps, right? It'll wave its way higher. But just look at how this has looked, right? Jump up, flatten out, jump up, flatten out, a little bit of drawdown, jump up, flatten out. It's just going to keep wiggling its way up to the point where at some point the Federal Reserve will have over $30 trillion on its balance sheet. It might not be until way into the 2030s, 2040, it's going to happen. And if we're smart about interest rates and we're smart about how we develop the economy and we're smart about taxes, things will get even better in America. And then we can complain about something else. All right, I'm going to Festa Italiana on the Milwaukee lakefront. That's what's behind me right now. This is that is the, well, I can't hardly see it. Here, should I do this? There you go. That's the dumb chair pops up. This is the Milwaukee Art Museum, and forward of it, more in the foreground, is the Summerfest grounds. So we have a giant park on the lakefront that we do festivals on, and we otherwise waste the space because we're too dumb to build it to be open year round. Someday somebody will figure that out. It gets talked about. I think Northwestern Mutual Life is going to do it at some point. In any case, I'm going to go have a cannoli, and I'm going to write an article, the macro dashes pieces, based on what I covered today. And then I will do the Global Trends ETF with asset allocation shifts. Shooter did his major markets update, so that's on YouTube already, and the article is up over at Fundamental Trends. I will copy it over to Margin of Safety Investing. Then we'll get on our regular stocks of the week back up and running again. And I have an energy policy article, it's probably going to end up being 3 energy policy articles about how to invest in natural gas, how to invest in alternatives, and how to invest in oil. So most of those will go public on Seeking Alpha Premium, but I will keep the stock picks in-house, and we'll just talk ETFs with the public. All right, have a good day. Enjoy the weather if you got good weather. My garden is looking good. I have not gotten beat up by the pot Nazis. We have my condo complex. There's some people who are very upset that some people have more than 6 potted plants. Whatever. They're not dead. They look nice. Go look at something else. All right. Have a good one, everybody.